Alright, so in this video, I'm going to be doing IAS1. Now, you might ask, what is IAS1? So, IAS1 basically are standards or rules to apply when you present financial statements. So, it's like when you're creating your financial statement of the business, what rules to apply, like what you put into the financial statements, what it must be, and so on. Now, IAS1 describes a presentation of financial statement, right? It aims to achieve comparability. Now, comparability is a very, very good concept used and it's quite popular use. Comparability means that you must make your financial reports, which is like your financial statements, comparable. So, what does it mean? If you're a business, your financial year for last year, your statement must be the same as this year. So, what do I mean by that? The accounts you use in those financial statements, the name of the accounts must be the same as the accounts you use now. So, when I look at the sales figure, if I look at a specific account now, I can look at the previous year and look at that account. For example, if you put stationery in your financial statement as stationery, in your last year's financial statement, it must also be stationary. So when I put two financial statements together, I can look at the stationary figure, I can compare. But if you in your previous year put stationery as consumable stores, and this year you put it as stationery, I can't compare the two. So that's a problem. So you need to make sure it's comparable. So if last year stationery fell under consumable stores, this year put it as consumable stores. Now, IAS1 covers all the notes, right? Statement of financial position, statement of comprehensive income, all those notes, right? But one thing it won't affect is statement of cash flows, right? Because that's different. Now, actually, statement of cash flows is here. Oh no, wait, this says all the financial statements, right? So yeah. Oh yeah, IAS1 sets out all financial statements. So any financial statement is covered by IAS1. Now, what is the purpose of financial statements? Now, it needs to meet the needs of users. Now, users can be anyone. If you're a person who wants to know how well a business did, you the best way to know how well a business did is to get the financial statements. You can look at the sales figures and so on. For banks, if you need loans, they need to see if you're capable of your business making money. You give them a financial statement. For public companies that own shares, you need to give investors information about your company. You give them financial statements so it meets the needs of the users. Now, IAS1 lists 8 general features, right, of to consider for financial statements. So we got fair presentation, going concern, accrual basis, materiality, aggregation, offsetting frequency of reporting, comparability, consistency. So now in the future slides we're going to discuss all this, right? First one is fair presentation and compliance. Fair presentation. So when you present the information in the financial statement, it must be fair, it must be truthful, it must be good. So what does it mean is you have to be truthful about it, right? You have to apply all the conceptual framework in your financial statements. So if the conceptual framework says, for example, you must be faithfully represented, so you can't lie in a financial statement and mislead people. For example, if you made 800,000 in sales, don't put it to 1 million and lie. Fair presentation, it must be fair. Everyone must have an advantage, a fair advantage in the world of businesses, right? So whenever you see fair presentation, all financial statement must comply with the conceptual framework, right? So obviously it's fairly presented, right? There's no unfair presentation. Unfair presentation is bad. You can get fines. Departure from IFRS. Okay, so remember, right now we're doing IAS1, but in IAS1 it says that if IFRS is International Financial Reporting Standards. So these are standards that are international, meaning all financial statements in the world must comply. The problem is this: all financial statements have to have these rules applied when making a financial statement, but some businesses basically can't apply these rules in IFRS, so there might be a problem and so on. So IAS1 says, okay, don't worry. If you can't apply a certain rule in IFRS 1, tell us what's the problem and you can leave it out. So basically, if basically if leaving it out is better for the financial statements, it'll represent it better for the users, then you can leave it out. But when you leave it out, you have to put why you left it out in the financial statements. You also have to say like what rule you broke. You have to say like what are the requirements you broke, why you did it, how you did it, because you need to tell in the financial statement on the notes that listen, I never followed this specific IFRS rule because so and so this and this happened, and it won't represent my financial statement fairly if I follow this IFRS. So yeah, departure from IFRS, breaking the rules of IFRS. So you can break the rules, but it has to be a valid thing, right? So, departing from IFRS, so if management believe that the compliance may lead to misleading information, so by following the rules, it might lead your financial statements to not represent something fairly or good, then you can depart from this unless department is prohibited. Sometimes some laws you can't like break. Oh yeah, comply with the standard but provide disclosure, patch the problem. So you have to provide information of why you obviously went by the IFRS or broke the IFRS. Disclosure of the non-compliance is required. You have to say why you broke it, right? You stay absent from school, you have to bring a doctor's letter, you have to bring a note. This is the exact same thing. You break a rule, you have to tell in your financial statements why you broke the rule. Yeah, so basically, a management conclusion of the financial present fairly position. Um, yeah, so basically, as what I said, right? The reason why that the treatment was considered to be misleading. So, in this whole thing, they're basically saying that in your financial statement, you must tell them why you broke the rule and why, if you follow the rule, why it will disrepresent your financial statements. But by following the rule, sometimes it's bad for your financial statement, right? It might not represent something fairly. Uh, okay, so departure required but disallowed. So, disclosure of the following is required. So these are all the rules you have to follow when you break an IFRS rule. So you broke an IFRS rule, right? Perfect. Actually, not perfect, but good. Now you have to say in your notes why you broke this IFRS rule. You have to say the offering of the IFRS. I mean the offending IFRS. The rule. State the rule. The nature of specific requirements. So obviously one rule is split up into different small rules. So the specific rule in that law you have to tell. Management's reason for believing that the IFRS. So basically, you as an accountant believe that you need to break an IFRS. That accountant needs to write exactly why he thinks that. The adjustment that the management believes should be made to achieve favorable implementation. You have to say by breaking the rule, now my financial statement can be more better. You see, sometimes following the rules, it's bad. Sometimes breaking the rules can be more better. I will agree. I will 100% agree. Having a 4-day week instead of 5-day week school is 100%. So if you want to stay absent for one day, good, because you can study and like you can mentally repair. But basically, breaking rules are sometimes good. So this allows you to break a rule, but you have to list all these out, right? And this has to be valid. You can't make your own stories up here. Jack and Jill went up the hill to fetch a pile of milk. With what I'm saying. Anyway, you get my point. Going concern. Now, going concern is very important, right? This will depend whether your financial statement will be represented in a certain way. Two options: you are a going concern. Second option: you're not a going concern. Most businesses are a going concern, and very little businesses are not a going concern. Now, you might ask, what is a going concern? A going concern is a business that can go into the future and operate. That's a simple definition. So what does it mean? If you're a business which making sales are profitable and you basically not in debt, okay, you very very good and you can operate in the future, you're a going concern. If you're a business who have debt, who have no assets, you have liabilities, you have loans taken out, you don't even know if next month you're going to make it, next month you're going into more debt, next month you're closing down, next month your business is not going to exist, next month you tell yourself that listen, I'm going to close my business, you're not a going concern, right? Going concern, a business will operate in the future. They know that. They're not going to close down. But if a business knows it's going to close down next year, that's not a going concern. So going concern, remember going concern, look at the word going. You can go into the future. Not a going concern, you're not going in the future. So an entity is either going concern. So when an entity is going concern, you represent the financial statement like normal. But if it's not a going concern, you basically have to represent your financial statements different. So like there's lots of rules and stuff, but basically you like put different values for your assets and stuff as if you're gonna sell it. It's liquidation values, all that complicated stuff, but we're not there yet. But basically it's different from a going concern. If you think or in doubt that you are a going concern, you represent it as a going concern. I mean, not a going concern. So if you're in doubt whether you're going to be profitable next year or what, but you're thinking you might close down, then it'll be continue operating as a going concern. Basically, if you have a doubt, right, uh, you have to represent it in your financial statements under the notes. So you have to say in the notes and listen here, we might not be a going concern, we might actually close down, but we don't know, we're just testing the waters. The notes help you to actually put all this information in so the financial users of the statement can see and know what you're thinking. Accrual base is very important, right? You're doing this from school. Accrual base is all income and expense must be received in the year and recorded in that specific year. If you earned 100 rand from a debtor this year, but that debtor didn't pay this year, you have to record the 100 rand sales this year, although it never come into your bank. You see, it's not cash. Accrual is not cash. A debtor gave me money this year, but I never get that money. What's the journal entry? Debit trade receivables, right? Debtor. Credit inventory, right? So he bought goods from us on credit, debit trade receivable, credit inventory. No, wait. What I'm saying? Debit trade receivable, credit sales. Yeah, sales. Yeah. Debit trade receivables, credit sales, right? And then obviously debit card, I say credit trading stock or whatever. But basically, you have to record that sale on that specific period, right? So all this, that's how you get accrued income, income received in advance, and all that, right? You have to, when you get an income or when you have an expense, you only record in the financial statement for that specific year. So if let's say next year, so let's say you own a building, right? And then you receive rent for next year in advance. So I'm here in 2023 and I'm in 2024, and in 2025 rent, that tenant is rich, so he gives me the money for that already, prepayment. I can't represent this as an income this year, only next year. Materiality and aggregation. Materiality and aggregation is the same but the opposite. Materiality, now what does it mean? If we look at the financial statements, so let's say if you're looking at the expense section, you have advertising, consumable stores, stationery, all expenses, rent expense, all that. If you see those things, all that are called material. They are material. So material basically are all like the accounts you put in those financial statements, right? They affect the user. They're very important, so you need to put them. Aggregation is immaterial. So another word for this is immaterial. It's not material. It's combined items that we believe that are not material, not to be shown separately. Okay, so very, 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 very simple way is this, right? Stationery now. Stationery in your financial statements, you might ask, why do you put one account for stationery in your financial statement? But why don't you put, like, example, your pencils, your pen? So let's say have a pen account, have a pencils account, have a rubber account, have a ruler account, have a book account. You can have thousands of literally those accounts, right, for stationery. But you say that those accounts, put it into one as stationery and put it in the financial statement stationery. So all pens, all that just falls under this one account stationery. Why? Because pen, if you have a pen account, a rubber account, page account, it's aggregation, it's not material. Somebody who wants your financial statements won't want how many pens or what's your pen expense, what is your book expense, what is your rubber expense. All those are stupid stuff. We need important stuff. So instead of representing this all separately in the financial statement, separately putting your pen in the financial statement, putting your rubber in your financial statement as an account, all those accounts, put it as one account, stationery. That will be material. Because when I want to look at the financial statement, I want to know how much stationery you used. You see my point? Rent income is it material, immaterial? It's material. Why? It's important. You have to have rent income shown. I want to know how much rent a person owned. Um, what about, let's say, interest income of 10 cents? Immaterial or material? Or let's say wait. Rent income, uh, yeah, rent income of 10 cents. Well, is it material or immaterial? Another word for immaterial, aggregation. It'll be aggregation. Rent, don't put a whole account for rent income of 10 cents. That is stupid. Put that 10 cent into another account. Make another account combine with like the rent or stuff. But basically what I'm saying is something that doesn't need to be, don't put a whole account in financial statement. That's stupid. That doesn't belong there. That's that doesn't make sense, right? Combine all of them together and put it into one. Segregate, items constitute a material separate class. Segregate, aggregate. So that's just the opposite. That segregate all to material. Yeah. So example, all pens, rubbers, puts in the stationery account. That's segregate. Separate class, look at the nature, function of item, materiality. So I discussed this materiality, right? The separate classes, but you put it into one. Material class. Yeah. So basically that's all, right? They're like accounts and like, yeah, basically that's it. Now, transactioning process, the way it works, right? You get a transaction, you go to the source document, you get a journal, ledger, trial balance, financial statement. We did this in Accounting 101. It's simple. Offsetting. Now, what is offsetting, you may ask? Simple example I'll give you, right? You owe me 100 rand, give me the 100 rand. But I owe you 20 rand. So I say that, listen here, if you owe me 100 rand and I owe you 20 rand, then you must only give me 80 rand. Does that make sense? I want you to really think about this, right? You owe me 100 rand. I owe you 20 rand. So why do you give me 100 rand when you can just give me 80 rand? That makes sense, right? If I owe you 20 rand, you owe me 100 rand. You got 100 rand in your hand, I have 20 rand in my hand. Instead of me giving you that 20 rand, you just pay me 80 rand. Does that make sense? That is offsetting. You're offsetting an expense and an asset in this case, right? So that's offsetting, right? Now, when it's allowed for certain applications. Reflects a substantive transaction. Yeah. So it's allowed when like you do it and it doesn't affect the financial statements, right? So offsetting. So set of an income and expense is allowed if a non-current sale of an asset. Okay, so you can read this, but basically, so let's say I purchase a vehicle for 10,000, but I sell that company a vehicle for 6,000. What is the price of the vehicle? So it's a trade-in. I get 4,000 rand. So that's basically offsetting, right? You're offsetting the cost of the vehicle, because the cost of the vehicle is not 10,000 rand. I'm giving them my vehicle of 6,000, so I only pay them 4,000, not 10,000. You see, offsetting. Setting of income expense that is not allowed. So when you can't do this, it's sales and cost of sales. Now, why? Sales and cost of sales is completely two separate things, and according to the law, you can't what is called, you can't offset them, right? You just can't. Sale and cost of sales are very, very important things in financial statements. You can't offset it. So same thing what I said here, debtor and creditor, right? You owe me 100 rand, I owe you 20 rand. You must just give me 80 rand. That's offsetting. Exactly, that's just offsetting. So you can't do that. Yeah, the saying, yeah, is allowed. Yeah, perfect. So we're allowed to do that, no problem. But you can't offset VAT. So SARS owes me 100 rand, I owe SARS 20 rand. You can't offset it and say SARS must only pay me 18 rand. No, can't work. VAT, SARS, government can't work. Frequency of reporting is annual, so all financial statements need to be given annually, published annually, done annually. If change in year, so if you can't do it 1 year and you maybe did it for like 11 months, you have to say why you did that for 11 months, what happened. So yeah, you have to basically say why you changed the year. Comparative information, I told you, It must be numerical and narrative. Now, what does numerical mean? So, in a financial statement, you must have two separate columns with the money price inside. For example, if this year is 2024, you must have the previous year 2023. So, if you have the sales figure, so do they picture us a financial statement somewhere? Okay, they'll do. We'll see just now. But basically, if you have sales in the statement of comprehensive income, where you put the money, you must have last year's sales, what you made, and then we put this year's sales. So that is comparative information. Narrative, you can say in the notes like what was this year's performance versus the current year performance. So what products you sold this year, what products you sold the previous year. So those comparisons, but it must be in words. We can put two prior years instead of one prior year. I mean previous year. So you can put like 2020, 2021, 2022, comparing 3 years together, or 2 years. Yeah. So all previous years must comply with IFRS. So obviously all the figures you get from previous years have to be IFRS compliant. Comparative information only applies to statement of financial position, but does not apply to the notes. Yeah. So statement of financial position only applies there to have comparative years, but not to the notes, right? Consistency. Now, what consistency means? Consistency means must be consistent, right? If you cook good food for the rest of your life. Don't cook good food now and then we get married. Don't cook good food. That's inconsistency. So consistency, all your financial statement for all the years must be consistent. They must be good, right? Put all the accounts the same thing as comparability. There we go. Comparability, it must be all the same. If you put stationery one account the last year, put it at this year, have to be the same, so you can compare. Be consistent, be the same. You accurate all the time, so be accurate all the time. Don't wake up one day and say you want to go and drink milk from a cow. Won't work. Go to the shop. Why did I even say that? Okay, never mind. Comparative information has to be compared to a previous year. You put stationery last year, previous year, put stationery as account this year also. Don't put another name. You wake up one day on the right side of bed and you want to say, oh, I want to change the financial statement from stationery to, I don't know, another funny name. Kuku kuku kaka. Don't do that, man. Go to the mental hospital. You can't do that. You're breaking IAS1. You're breaking the financial standards. You're gonna go to jail. Don't do that, man. Come on. Consistency. Wait, didn't we just finish this? Yeah, consistency we finished. Financial report. What's a financial report? Financial report has all financial statements together. Everything financials together in a financial report. So all the financial statements, reports. Now, what are reports you get? You get directors' reports. So directors of a company are people that control the company, decisions, all that. They have to put their names in there, the salaries, what they did to the company, and so on. Environmental report. You have to it's very good with factories, so they'll put a report on how much carbon dioxide they released in the air, how much of pollution they did in the air, how much of birds they killed, how much of animals they killed, and so on. Value added report is basically a report that shows the good things that happen in the company. So value added could be your sales, how you increased your sales, how you did a lot of good things to your employees, how you treated them for dinner, how you gave them contributions, medical aid, all that value added, right? Value added report could also include your supply chain. So from the supplier, how the product got value added. From the supplier, it went to the manufacturing, it got painted, it got that value added go up to the final customer, happy customer. IAS gives the structure of components of financial statements. Yeah, so it has to be obviously a structured financial statements. So it has to be like sales, cost of sales, gross profit, other operating income. So you know your structure easy. Financial statements, identify financial statements. So all financial statements have to have a title, has to have the name of the business, have to have a reporting period when it's done, have to have what currency you're working. I don't know if you don't put the currency. I don't know whether I'm working with dollars, rands, or yen. Literally, I don't know. Tell me. Separate entity and groups. Now, what is the separate entity and group? Okay, first, level of rounding easy, 2 decimal place, 1 decimal place, and so on. What is the difference between separate entity and group entity statements? Um, let's see. Take a lot, right? Take a lot. Take a lot is a child company. No. Wait. Okay, so Take a Lot is owned by a big company called Naspers. Naspers owns Take a Lot. So Naspers is an adult, is a parent. Take a Lot is a child. If you look, if you look in the financial statements and it gives you Take a Lot only, the financial statement of Take a Lot only, it's called separate entity. But if you have to look at uh, the Take a Lot group financial statements or Naspers group financial statements will all the financial statement of their children. So of their children, so Take a Lot will be in the statements, other companies their own and so on. So group financial statements, you get the adult and it shows you all their children. Separate entity is like only that one particular company, only one child. Contents of financial statements must have a financial statement of position, comprehensive income, changes in equity, cash flows, notes, statement position of the earliest comparative period. So you must have comparing figures, 2 years comparable figures, and reports. So you must have like a direct report on so on all these reports. Statement of financial position. It shows you your economic resource in your business, like your assets, your liquidity, your liabilities, your solvency. Um, Balance sheet shows you your assets, your current assets, current, non-current liabilities, equities, and so on. What is the difference between current and non-current asset? Very, very easy. Current assets are assets that you own for 1 year and less. Non-current own more than a year. Or you can say, I'm saying this in the most simplest manner possible, but like economic definition is like an asset that you have for like 1 year, and this is more than 1 year. Right? Current liabilities are liabilities that you owe for 1 year. Non-current is current liabilities that you own for more than 1 year. Monetary, non-monetary. Anytime you think of monetary, think of money. So monetary is literally money. Account receivables is physical money that they owe. Deposits are physical, cash physical. Non-monetary is non-money. PPE is what? Are assets. So like your vehicles, they're not money, they're not actual money. The patents, goodwill, copyrights, these are not physical forms of money. Statement of financial position lists all the items at IAS1. So basically, they show you the simple structure. So it's easy. Assets, equity and liability, current liabilities, non-current, and so on. So you know how to do this structure, right? You can pause and see, but that's how you do the structure. Statement comprehensive income has two parts: profit or loss section, other comprehensive income, and all these things. So basically, statement comprehensive income. I don't know why they just show different things here. We do one like the one we did in school: sales, cost sales, gross profit, other operating income. They got operating expense. They got net profit, profit before all that. That's a simple one. This is also the same one, but it is complicating, guys. So don't even worry about this. To be honest, it just confuses more people. But yeah, they can have the income statement like this, or they can have the statement, the income statement split. So they can work out the profit over here and then take that same profit, put it here and minus the expense and get the net profit. But we do it one time. So yeah, I like the one time method. That's very, very easy. Disclosure. So profit and loss is split into two subheadings. Record either function, each method is coincident. Okay, so profit and loss statement and the statement of comprehensive income is two different things. You might say why. Profit and loss, right? Statement of comprehensive income. Okay, so you know how in your statement of comprehensive income you get in your income account, so let's say revaluation, surplus, or you might have an increase in revaluation, or you might have profit on sale of asset. Those things don't go into profit and loss, right? So that's why they're like split between the two headings in your profit, what goes, what not goes, and so on. But really not that important, to be honest. Yeah, so basically there's a couple of ways to it. I think I missed one something. Oh yeah. There's two ways to present financial statements, like your income statement: function and nature method. The what method is the nature method? The nature method list the accounts what they actually are, right? So example, depreciation. The function method lists the accounts as what is a function of the particular business. For example, the depreciation is not listed as a separate account here, but in the distribution cost, depreciation is somewhere in there. Administration, depreciation is somewhere in there. So for example, administration is the office equipment. Depreciation you can't see it, but it's in the administration cost. So function, it's like it groups the accounts in functions and not actual like things. Reclassification of adjustments. Okay, so let's say you wake up one day and a cop is waiting in front of your door and says, "Listen here, you are a dummy. You made an absolute stupid mistake." And you're like, "What mistake I made, cop?" And the cop says, "Dude, you never you basically made a mistake in all your financial statement for the last past 10 years of a company. So imagine you're accountant of a company and for 10 years you'll be doing the wrong thing in the financial statement each and every year. So now, via the law, you have to literally change all those financial statements to make it comparable, to make it right, to make it good, fairly represented." So that's what this whole thing says over here, right? You have to reclassify adjustments, redo your financial statement of the previous years because you made a big flop. Changes to the profit and loss account. Okay, so as I said, right, when you change your financial statement of the previous years, you have to say to what you're changing, what not you're changing, what is the accounting policies, and so on, what period you're changing. So you made a hit or flop for 10 years of your life. I don't know, you shouldn't even be an accountant. So they'll probably even fire you after this. But basically, those financial statements that were mistakes previous years have to be corrected. Statement of comprehensive statement of changes in equity. Statement of changes in equity is basically, well, we are going to do it. No, we actually did it already. It's basically it gives you what happened during the year to affect the equity account, right? So all this stuff here basically. Okay, so statement of cash flows. There's a separate IAS for the IAS1 that we're gonna do in detail. So we still have to do it. Yo. Yeah, but basically it says like how the bank balance changed after the previous year, this year, and so on, month to month stuff. It's not that bad to be honest. Well, in school it wasn't bad statement of cash flow. I don't know here in university. This is not shock you with some statement of cash flow you never seen in your life. Skeleton. So obviously you need to know how the structure of all statements are, right? So you can obviously make them in the exam, draw them up. So all these are just notes. So this is what I was saying about notes, right? You make notes on all the accounts of what is in your financial statement so people can see it, compare, know what you need to know. So that's basically it. So IAS1, to be honest with you now, could come out for marks, but like to be honest with you, I don't think it's coming out for this test one because like, but it could come out, but like not so much of marks. It's mostly fixed assets and what's it called, conceptual framework. Because this is more of financial statements, so they can maybe ask like 1 to 5 mark question, 2 3 mark questions, or so on. Or I could be wrong, but basically, if all this relates to financial statements, then yeah, that's maybe just now, not now. But yeah, that's it for today. IAS1 complete.